Welcome everyone to this explainer. Look, today we're going to treat the global financial market like what it really is, a massive, perfectly interconnected ecosystem. We're going to dig right into the tectonic plates that are shifting the entire global financial machine right beneath our feet between 2026 and 2028. We are talking about sweeping foundational changes that alter absolutely everything, from the largest universal banks on the planet all the way down to the individual retail traders sitting at their desk. So we're taking a macro to micro journey today. We'll start with the Basel IV capital squeeze, then move to rewiring SEC market rules, Europe's new MiFID III era, Nasdaq's crazy 23-hour trading day, and wrap up with the new rules for retail traders. To immediately wrap your head around the sheer scale of these changes, just consider this staggering number, 40 to 60 billion euros. That's the projected potential capital shortfall for French and German corporate and investment banking divisions alone over just the next 18 months. Seriously, this isn't some minor regulatory tweak we're talking about. This is a fundamental rewiring of the system. Let's look at why this is happening. Okay, let's dive into Section 1, the Basel IV capital squeeze. You can really see a massive divide happening globally right now. When Basel IV recalculates how banks calculate their risk-weighted assets, or RWA, European universal banks are going to face massive inflation. We're talking an estimated 15 to 25% increase. Now contrast that with their US counterparts, who are looking at a much more modest 8 to 12% jump. And that's largely because US banks already operate under stricter domestic minimums, thanks to the Collins Amendment. What this actually means in the real world is that this shift is fundamentally reshaping lending economics across core business lines. As central banks tighten monetary policy and hike up interest rates, this brutal dual pressure of rising capital requirements and higher funding costs creates a massive strategic bottleneck. Banks are basically being forced to make some incredibly difficult choices about their business mix and where they operate geographically. The crucial takeaway here is that trading desks are facing a real reckoning. The new standardized credit valuation adjustment methodology, it's projected to increase capital charges for derivatives by 40 to 70%. That's huge. Plus, internal ratings-based model floors are suddenly causing capital allocations for residential mortgages to double or even triple in some European regions. Because of this, we're already seeing a massive strategic retreat. Global banks are dumping non-core portfolios at a discount and completely exiting capital-intensive trading activities, just to optimize their balance sheets. Let's step into Section 2, Rewiring SBC Market Rules. So just as a quick refresher on our market plumbing, Rule 611, known as the Order Protection Rule, has been our historic backstop. It exists to protect limit orders, ensuring your trades don't execute at prices inferior to protected quotes across all our fragmented exchanges. But here's the wild part. The SEC is actually proposing to rescind Rule 611 entirely. It's a massive paradigm shift. We're moving away from the old world where broker-dealers were absolutely forced to connect to every single exchange, even the low-volume ones. And we're stepping into an environment of intense best execution pressure. Without that regulatory floor, brokers are going to have to rely entirely on their own sophisticated routing systems to justify their trades. And those low-volume exchanges, they might just lose the protective moat that used to guarantee them order flow. Moving across the Atlantic to Section 3, Europe's MiFID III era. Europe is tackling this market fragmentation issue in a totally different way. MiFID III aims to heavily reduce fragmentation by officially rolling out a consolidated tape. This is a game changer. It provides a single, EU-wide aggregated view of market prices across shares, bonds, ETFs, and OTC derivatives. It basically makes the market infinitely more transparent for everyone involved. The ultimate goal of MiFID III is simple, really. Absolute transparency. To get there, Europe is outright prohibiting payment for order flow. That means brokers can no longer get compensated for routing client orders to specific venues. On top of that, they're scrapping the old complex volume waivers and replacing them with a strict single volume cap set at 7% for dark trading. It's all about bringing price formation right out into the daylight. Now for Section 4, which is fascinating. Nasdaq's 23-hour trading day. To really see the real-world impact of a market that basically never sleeps, let's trace the traditional steps of a confidentially marketed public offering, or a CMPO. Back in the day, underwriters would discreetly wall-cross investors to gauge interest while the market was comfortably closed. Then they'd flip the deal to the public after hours and price it the next morning, right before the opening bell. The whole strategy relied heavily on the market being closed, so they could avoid shorting and speculative pressure on the stock price. Which brings us to a massive, multi-million-dollar question for issuers, underwriters, and market participants alike. What exactly happens when the market never sleeps? Because with Nasdaq's new rule, daily trading will only pause for one single hour each weekday, from 8 a.m. to 9 p.m. Eastern Time. When the market only hits pause for 60 minutes a day, your risks multiply overnight, literally. If confidential deal information leaks during this new night session, it's going to instantly impact live on-exchange prices. And if the stock price moves materially overnight, that could easily trigger immediate Regulation FD cleansing obligations, forcing companies to scramble and issue public press releases. We might even see a situation where dealmakers are forced to conduct their confidential wall crossing over the weekend, just to find a window where the exchange is actually closed.
Finally, let's zoom all the way in for Section 5, New Rules for Retail Traders. For a quarter of a century, retail traders have been shackled by the rigid pattern day trader rule. You know the one. It required a strict $25,000 minimum equity balance just to day trade. Well, that is officially being replaced by FINRA's new intraday margin deficit rules. This new standard gives you way more freedom to participate by dynamically tracking your real-time margin exposure based on your actual intraday trading activity. Now, while this new FINRA framework definitely offers more freedom, it demands serious discipline. Brokers are allowed to make a single daily calculation of an account's deficit, and sweep program deposits at FDIC banks do count as credit. But listen closely, because here is the absolute catch. If a trader fails to satisfy an intraday margin deficit for 5 business days, the broker is strictly required to trigger a harsh 90-day freeze on that account. No new short positions, no new debit balances, you're frozen. Retail traders also need to wake up to the fact that the definition and enforcement of insider trading have completely evolved. We're hitting 2026, and regulators aren't just reacting after the fact anymore. They are utilizing AI to actively monitor algorithms, perfectly cross-check trade timing, and track options flow for any non-public data footprint. The definition of an insider has expanded way beyond executives. It now includes literally anyone executing a trade using material, non-public information, even algorithmic traders who are just scraping restricted feeds. So, how do you survive and thrive without crossing those regulatory lines? Professional traders are translating all this market data into comparative cheat sheets. By closely watching real-time tick call versus put metrics alongside options activity, they can actually gauge institutional momentum. Think about it. If call ticks are rising faster than put ticks with heavy at-the-money options accumulation, that's a massive bullish signal. If put ticks are accelerating right at resistance, it's a glaring bearish warning. They're using this newly transparent public tape to figure out exactly where the smart money is moving long before the price even reacts. Which brings us to the ultimate question. As we wrap up this explainer, I want to leave you with this final thought. In an ecosystem with zero downtime, shifting institutional capital floors, and AI-driven surveillance tracking every single tick, who really has the edge? And more importantly, how are you going to adapt your own strategy to stay ahead in this totally rewired era of finance? Thanks for joining us for this explainer, and keep learning.